Well, I think the playbook as we get later into cycle but not end of cycle is one, expect more volatility and have a shopping list of things you want to buy. Two, you have to be more selective. Early in the cycle, rising tide lifts all boats. Now you want to be a little bit more targeted. We've seen huge dispersion across sectors this year. I think that opportunity continues. And third, most importantly, stay disciplined. Investing is not a on-off switch, but rather a series of dimmers, so you want to make slight adjustments. We're looking at a more targeted sector-based approach within our allocations in the U.S. Specifically, we like tech, healthcare, balanced with energy on the cyclical side.
So you're not looking for defensive names, value names to continue with mean reversion?
I think that we're seeing some of the value names beginning to come back. I think that energy is a place where later in the cycle, we've seen this huge disconnect between oil prices and energy stocks. Historically, every late cycle period, energy has outperformed. And I think that that's a place where, on the value side, there's a good opportunity.
Though it's down 13.5% this month and the worst performing sector this week.
Yeah.
Not happening yet.
No, well, I think people are looking at the headlines around the macro data, around the pullback in oil prices, and they're punishing without looking at the actual fundamentals of the space. Energy companies are actually, for the first time in a long time, finding a little bit of capital discipline, even with higher oil prices. And the stocks have actually lagged the oil prices by close to 50–60%. So I think this is an opportunity. And of the parts of the market that people are looking at, energy remains very much unloved by investors, even with the rally we saw earlier this year.
John, what about you? Do you go for unloved sectors or safety?
Yeah, we got to go for the unloved sectors here. We continue to like technology. We think the multiples are becoming more attractive. And when you think of technology, technology is right now, we believe, in a place where the automobile was where it began to replace the horse. So we like tech, consumer discretionary. We like industrials, which we believe, because of all the sensors on industrial products and its relation to the Internet of Things, we continue to like that, very, very much the new technology. And we continue to like, as value plays, we'd say consider financials and healthcare as the defensive we'd like.
And we talked about the buying list earlier. One of the things that we've been buying within tech specifically is software. And if you look today at the CapEx spending in the GDP report, it was pretty uninspiring, except when you look at the spending on software. As we move later in the cycle, with labor markets getting tight, companies are being forced to try to find productivity. They're spending that on software upgrades rather than factories.
Do you think tactically your buying opportunity lasts into year end? Or do you fear missing a year-end run-up?
I think that expectations at this point and a lot of the sentiment indicators that we look at have come down really meaningfully. A lot of stocks look pretty oversold at this point. So I actually think that we could be positioned for a bounce into year-end, especially if we settle down a little bit in terms of some of the trade rhetoric, we get through midterm elections. I think that we're set up to move higher. But again, markets are going to be choppy and you have to take advantage of that.